Flex absolutely crushed consensus for Q1 fiscal 2027. I mean, we are looking at top line revenue of $7.928 billion, which is up 21% year over year. And adjusted EPS hit a record $1 flat, up 39%. They also raised full year guidance across the board, so the market has a massive amount to digest today.
Yeah, they really did. And, even if you look at GAAP EPS, it was 76 cents, which is up 52%. But honestly, while those headline numbers are stellar, the real reason the stock is dominating the conversation right now is the massive strategic pivot they announced alongside the earnings.
Right, the spinoff. It's huge news. But before we get to the spinoff, we really have to talk about the margins because, growing revenue by 21% in the manufacturing sector is great, but they actually expanded their adjusted operating margin by 70 basis points, bringing it to 6.7%.
Exactly. And that resulted in an adjusted operating income of $534 million, which is a 35% jump, in this macro environment. With labor costs and inflation being just constant headwinds, making significantly more profit on every single dollar you bring in takes incredible pricing power.
It really does. I mean, 70 basis points might sound like a tiny fraction to some, right? Like, oh, 0.7%, who cares?
Right.
But on nearly $8 billion in quarterly revenue, those fractions equal tens of millions of dollars in pure profit. It's like a diner flipping to a high-end steakhouse model.
That is the perfect analogy, because this isn't a story about economies of scale, right? Where they just pumped out more volume on the same old assembly lines to, lower their average cost.
Yeah, exactly.
This is a structural, totally deliberate shift toward high-value end markets. Margin expansion across a business this large proves that Flex has real pricing power right now.
Because customers are willing to pay a premium. They aren't just assembling generic plastics anymore. They're building highly complex mission-critical systems.
Right. And to see how they're changing that menu, you have to look past the top-line revenue and dig into the actual segments. Specifically, the segment driving this whole narrative, Cloud and Power Infrastructure,
Yeah.
or CPI.
CPI, this is where we get into the whole AI bottleneck play, because CPI covers thermal management, compute, and critical embedded power products. For Q1, CPI brought in $2.2 billion in revenue.
Which is a 35% growth rate year over year.
A 35% growth rate for a physical manufacturing division is just wild. And the operating margin for CPI sits at 9.7%.
Which is exceptionally high for hardware.
Oh, absolutely.
Yeah.
So let's break down the physical reality of what CPI is actually selling to generate that kind of growth. Like, how are they solving the data center problem for these tech giants?
It really comes down to power density. The latest generation of AI chips, the GPUs running these massive language models, they draw an astonishing amount of electricity. You can't just plug next-generation AI servers into a standard data center wall outlet. They require highly specialized, embedded power systems that regulate voltage with zero interruptions.
Because if the power fluctuates even slightly, I mean, you could interrupt a training run for an AI model that costs literally millions of dollars in compute time.
Exactly. That's the core issue.
Oh.
And then there is the byproduct of all that power, which is heat. Standard air conditioning cannot physically push enough cold air through the server racks to keep these new chips from melting.
Yeah, the physics just don't work anymore.
They don't. So data centers are shifting to advanced thermal management, like liquid cooling systems, where coolants are pumped directly over the processors.
Yeah.
And Flex designs and manufactures these critical power products and cooling systems.
So as utility companies and tech giants scramble to build more of these AI data centers, Flex is just sitting there with the specialized hardware they desperately need.
Sitting right at the choke point, yeah.
Okay, so CPI is the rocket ship, but Flex is still a massively diversified company. How does this explosive growth in AI infrastructure compare to their more traditional business lines? Because they still have two other huge segments.
They do, and those segments are performing very differently, which I think really highlights the strength of their broader portfolio. Let's look at RMS-regulated manufacturing solutions.
Right, the healthcare and industrial side.
Exactly. This segment focuses on complex medical devices, drug delivery systems, as well as industrial and automotive markets. RMS generated $2.7 billion in revenue, growing at a solid 12%.
But again, the real story in RMS isn't the 12% revenue growth, it's the profitability.
Oh, totally.
Because operating income for RMS jumped a staggering 40% year over year, hitting $176 million. That is a 130 basis point margin expansion.
Bringing the segment margin up to 6.6%.
Right. So if revenue grows 12%, but profit jumps 40%, going back to our restaurant analogy, that means they are aggressively dropping their low margin items.
Yeah, focusing almost entirely on the prime cuts. It shows incredible operational discipline. They're optimizing their product mix, focusing heavily on connected medical devices and complex industrial grid infrastructure.
Where the barriers to entry are just ridiculously high.
Exactly. I mean, it's incredibly hard to get a medical device approved by regulators. So once you are the manufacturer of record, your pricing power is completely secured for the life of that product.
And then there is the third segment, ITS, or Integrated Technology Solutions. This one covers communications, enterprise infrastructure, and consumer lifestyle products like appliances. ITS brought in $3.1 billion, growing 20% year over year.
What really stands out in the ITS segment, though, is how diversification kind of saved the quarter for them. Management actually noted in the presentation that consumer end markets in the lifestyle division were weaker than expected.
Right, because people just aren't buying as many consumer electronics or washing machines right now.
Yeah, consumer discretionary spending is tight. But that weakness was entirely offset because their advanced networking equipment outperformed expectations.
So you have steady growth and huge margin expansion in healthcare and industrial. You have enterprise networking completely offsetting consumer weakness. And you have an absolute supernova of growth in the AI-driven cloud and power segment.
Which brings us to the most fascinating part of this entire earnings report.
The spinoff. Because CPI is growing at 35% and boasting nearly 10% margins, management has decided to just spin it off into its own independent, publicly traded company.
It is a classic corporate strategy for unlocking shareholder value. They are targeting a tax-free spinoff to existing shareholders with the goal of closing the transaction in the first quarter of calendar year 2027.
Okay, I have to play devil's advocate here, though. Put yourself in the shoes of a long-term retail investor. CPI is your fastest growing segment. It has the highest margins. It is perfectly positioned in literally the most lucrative sector of the global economy right now. Why on earth would you carve it out? Aren't you just amputating your best growth engine?
I get that. It seems counterintuitive until you look at how Wall Street actually prices different types of companies. In finance, there is something known as the conglomerate discount.
Okay, explain that for people who might not be familiar.
Sure. So when a single company does a dozen different things, say manufacturing vacuum cleaner components, building medical drug delivery systems, and designing liquid cooling for AI servers, the public markets struggle to value it efficiently.
Because investors who want to ride the AI boom might not want their capital tied up in consumer appliances.
Exactly that. By separating CPI, both companies achieve a much sharper strategic focus. The market can now value the new independent CPI company as a pure-play AI and cloud infrastructure stock.
And pure plays always get a premium.
Always. Historically, pure-play tech infrastructure companies command significantly higher valuation multiples than diversified legacy manufacturers. $1 of earnings in a pure AI company is often rewarded with a much higher stock price than $1 of earnings in a blended industrial conglomerate.
So it's really about letting the market price the AI asset for what it truly is without the baggage of the slower growing divisions holding the multiple down. It's kind of like a famous band breaking up.
Oh, that's a good way to look at it.
Right. Like
Yeah.
the lead singer who is writing all the current massive pop hits goes solo to capture that huge pop star valuation. Meanwhile, the rest of the band forms a highly respected, deeply profitable studio group.
That's a brilliant way to frame it. The remaining entity, which we can call Coreflex for now, it doesn't just disappear. It remains a highly profitable, highly diversified business, generating over $5.8 billion a quarter in revenue.
Made up of the RMS and ITES segments.
Exactly. And now, both entities can tailor their capital structures. The new CPI company might use its high-flying tech stock as currency to, say, acquire emerging Silicon Valley tech startups.
While Coreflex might focus on paying steady dividends and optimizing its global factory footprint.
Right. And they're moving quickly, too. The presentation notes that they expect the initial Form 10 regulatory filing to be available in September 2026.
Oh, wow, that's fast.
Yeah, and they are planning a joint investor day in November to outline the independent financial roadmaps for both companies.
Which naturally brings us to the forward guidance, because there is a very interesting catch buried in their projections.
There always is.
Right. Following this record Q1, Flex raised their full-year fiscal 2027 guidance. They bumped revenue expectations up to a range of $33.7 to $35.2 billion, and they raised adjusted EPS guidance to a range of 4.42 to 4.74.
Which is undeniably bullish. Even their immediate Q2 projections are incredibly strong.
They are. But amidst all these raised forecasts, there is one critical metric that took a steep dive. Their expected free cash flow conversion dropped significantly.
Yeah, it really did.
It was previously expected to be roughly 60%, and they have now revised it all the way down to approximately 40%.
For anyone unfamiliar, free cash flow conversion is a vital health metric for a business.
Yeah, think of it like your personal paycheck. Your gross salary might look fantastic on paper, but after taxes, health insurance, and maybe a mandatory uniform fee, the actual cash you take home and can put in your savings account is much lower.
Right. For a corporation, free cash flow is the cold, hard cash left over after all the capital expenditures and operational bills are paid.
So when management says the conversion rate of their earnings into free cash flow is dropping by 20 percentage points, that means a massive amount of cash is suddenly exiting the building.
Yes, it does. And the reason for that drop is explicitly tied to the spin-off strategy we just discussed. This is the direct bill for separating CPI.
Meaning, you have to spend an absolute fortune to spin off a multi-billion-dollar business.
Disentangling a highly integrated global business unit is an incredibly expensive undertaking. The revised 40% figure now absorbs the one-time separation costs required to execute the transaction.
Because they share so much infrastructure right now.
Exactly. You have to duplicate massive IT and ERP systems. You have to separate shared supply chains, physically divide factory spaces, hire 2 separate sets of legal and administrative teams.
Establish entirely new corporate HQs.
Right. It is the short-term financial friction required to unlock the long-term structural value. It definitely hurts the cash metrics today, but management clearly views it as a necessary tool to reach that pure-play valuation in 2027.
It's a calculated investment in corporate structuring. But look, a 21% growth rate and a strategic value-unlocking spinoff paint a very optimistic picture. But it's vital that we explore the significant risks outlined in these sources.
We have to.
The forward-looking statements section of this earnings presentation is incredibly dense, and it details several severe headwinds that could derail this entire trajectory. We aren't just here to cheerlead the numbers. We have to look at the reality of operating a global supply chain.
The first major category of risk is tied directly to the execution of the spinoff itself. A separation of this magnitude is fraught with operational danger. The sources explicitly warn that the spinoff might cost significantly more than their current estimates.
Yeah, those IT separations always run over budget.
Always. It could also take longer than the targeted early 2027 timeline.
And perhaps the most dangerous risk they flag is customer disruption. Imagine you are a major tech client building a $5 billion data center. You are used to dealing with a single integrated Flex ecosystem for your medical, networking, and power needs. If there's friction, miscommunication, or delays during the handover to the new standalone CPI company, you might just take your massive contract to a competitor. You don't have time for their corporate growing pains.
Exactly. And beyond the corporate structuring, there are severe macro and geopolitical risks. Flex operates in a highly volatile global environment. They specifically cite the potential for high or rising interest rates, which increases the cost of borrowing for their clients.
Which could potentially slow down those massive, capital-intensive infrastructure projects.
Right. It is always fascinating to see how global politics directly impacts a balance sheet. Management's forward-looking statements explicitly flag trade conflicts as a direct threat. They highlight the risk of further escalation in sanctions or tariffs between the U.S. and China.
Which is always a looming threat for manufacturers.
Definitely. They also point to the ongoing conflicts between Russia and Ukraine and developments in the Middle East, specifically involving Iran.
For a global manufacturer, those aren't just news headlines. Those are direct threats to the physical movement of goods. Global supply chains are incredibly fragile. The presentation actually points out their reliance on single-source or primary source suppliers for certain critical components.
That is the classic weakest link problem.
Yeah. You can have the most advanced factory in the world, ready to build a $50,000 liquid cooling server rack. But if a single factory in Asia that makes a specialized 10-cent valve gets shut down by a tariff, a localized conflict, or a shipping lane closure,
your entire multi-billion-dollar segment grinds to a halt.
Exactly. You cannot ship the product without the valve.
The risk of inventory obsolescence is another major factor they disclose, which is particularly relevant for the tech and communications sectors they serve.
Because technology moves so incredibly fast right now.
Yes. When you are building cutting-edge hardware, the product life cycle is incredibly short. If AI chip architecture changes fundamentally in 6 months and customer demand shifts rapidly to a new standard, a manufacturer can be left holding massive amounts of excess inventory that is suddenly completely useless.
The total write-off.
Right. So true analysis of this earnings report requires balancing the excitement of 35% segment growth with the highly delicate global supply chain holding it all together.
Okay, let's pull all these threads together. Flex is executing a textbook pivot here. They are successfully riding the massive wave of AI and utility infrastructure demand by providing the critical power and cooling hardware that the digital revolution requires to function physically.
Yeah.
That positioning translated into a 21% revenue growth in Q1, pushing their top line to $7.9 billion and driving adjusted EPS up 39% to a record $1.
And strategically, they are capitalizing on that exact momentum. They are absorbing short-term cash flow hits to spin off their cloud and power infrastructure segment into a standalone company by early 2027.
Aiming to capture that premium, pure-play tech valuation.
Exactly, while leaving a deeply profitable, diversified core business to generate steady returns.
But they are doing all of this while navigating the very real physical constraints of global manufacturing. From single-source supplier bottlenecks to the threat of international tariffs, it is a massive operational balancing act. But the Q1 numbers prove that right now, at least, they're executing it exceptionally well.
They absolutely are.
Which brings me to a final thought for you to ponder. As the AI boom continues to demand exponentially more physical infrastructure like more gigawatts of power, more advanced liquid cooling, more industrial grid capacity, we are going to see a clash between traditional manufacturing and next-generation tech valuations. Will we see other diversified manufacturing giants decide to carve out their high-tech divisions to chase that premium stock price? If you look across the industrial sector today, what other quote-unquote boring companies might be hiding an absolute AI goldmine deep inside their product portfolio, just waiting to be spun off?
That is definitely the trend to watch going forward.
Absolutely. That's something to keep an eye on as earnings season continues. Make sure you follow the show for our daily earnings coverage so you never miss a beat on how these structural shifts are shaping the market. Thanks for listening to this deep dive.